Now let's look at the case of a partnership firm. If you recall, in India, a partnership firm is considered as a taxable unit, which means that if a partnership firm earns some income, they have to pay tax on that. And the distribution by the partnership firm to the partners is considered as exempt from tax. Right? Now suppose, think of a situation where an Indian company pays some form of income to a partnership firm, and there are certain partners in that. The issue which comes up is the partnership entitled to the benefit of the treaty? It is entitled only when it is liable to tax, right? But there could be two situations for taxation of partnership firm. When we look at the tax rules of the country of residence, a partnership firm may be considered as fiscally transparent. Now what this means is, suppose $100 were paid by the Indian company to the partnership firm, this is not going to be taxed in the hands of partnership firm. Instead of this, it is going to be seen who are the partners. Suppose there are two partners, A and B, and they share the profits and losses equally. So A gets $50, B gets $50. The taxation in the country of residence is in the hands of the partners. The firm is treated as fiscally transparent. In such a case, it is not liable to tax in the country of residence, and therefore it is not entitled to the benefit of the treaty. But the partners, which is A and B, because they are liable to tax in the country of residence, will be able to claim the benefit of the treaty vis-a-vis their facts on the respective $50 of income that they get. However, if this firm was not treated as fiscally transparent, meaning that this $100 was taxed in the hands of the partnership firm as their income, right? In that case, it is entitled to the benefit of the tax treaty. Now coming to certain exclusions, which means certain people who are not considered as liable to tax and therefore are not entitled to the benefit of the treaty. That is, people who are taxable, person who is taxable only for income from sources in or capital situated in that state. So if you are taxable only for sourced income, then you are not considered a resident of that state. So let's say if there is a US person who wants to invest into India, right? He wants to claim the benefit of India-US treaty, but insofar as US is concerned, he is taxable only for income from sources which are situated in US or capital situated in the US. In that case, he is not going to be considered as a resident of US and therefore will not be entitled to the benefit of the India-USA treaty. Foreign companies which are not taxed on foreign income, they are generally not considered as residents of those states. So let's say again, if there's a foreign company which is UK based, they derive some income from US, right? And they are not taxed in US on their foreign income, then for India-US treaty purposes, they will not be considered as a resident. Person who, under treaty, are resident of a third state, right? Obviously, they will not be considered as resident. And in case of people who migrate tax residency, the benefit of earlier residency will be given until the date of migration. Let me just explain this here. So suppose in UK, there is Mr. X. He was a tax resident until 31/3/2016. Then he migrated to US and became a tax resident of US. He will get the benefit of India-UK treaty for incomes which are there up to 31/3/2016, and then thereafter it will be considered under the India-US treaty.